Good morning, investors, and welcome to Times Square. I'm Dan Kerrigan from NASDAQ, and we are honored that all of you are here with us today, and those of you watching us online to see the presentation about iron condors generating income with defined risk. Today's presenter is Joe Burgoyne from OIC. Please welcome Joe.
Okay, Dan, thanks, buddy. Hi, everybody, and welcome to everybody online. And as Dan said, thanks for making the effort to get here. It's not always easy, so thanks very much. We're going to talk about iron condors. Dan gave a very thorough presentation about the covered call, round one. We're going to kind of come back to the covered calls when we go into our third presentation about the collar in an hour or so. But we did want to mix it up a little bit here, which we're going to do with the iron condor. And I think one of the things about the options industry, some of the names stink. I mean, if you don't know options, the nomenclature, all the terms can be darn, I think, intimidating. You got to learn a whole new language. What I think is really important is we get away from kind of the crazy terms and we understand the core concepts. They're probably my two favorite words when it comes to options education. Core concepts. So hopefully an hour from now, you got a couple core concepts that will allow you to have a real clear understanding on what the heck this beautiful creature, the iron condor, is. You know, our typical disclaimer, as Dan pointed out very thoroughly, options aren't for everybody. Most of you in here, I think, actually, Dan asked how many were doing covered calls at the outset. How many are using options who are in the crowd? Okay, almost 100%. And online, I can't see your hands, but I'm guessing many of you as well. The ODD, the options disclaimer document, has an awful lot of information. So you're familiar with it since most of you are trading options. But options do involve risk. And as Dan said repeatedly, the mission of OIC is for you to understand, the benefits and risks of these fantastic financial tools. They're great financial tools, but you got to use them the way they, I guess, kind of match up with your risk tolerance. And again, Dan spoke to that quite a bit this morning. As I mentioned at the outset, in introducing Dan at the beginning, I've been lucky enough to be part of OIC for 9 years. I feel extraordinarily fortunate. We are funded by the industry. The slide says 25 years. The industry started in '73. We started in '92 after the '87 crash. And it was the forward thinking of industry leaders who said, we got to get out on the street and educate investors about the benefits, but as Dan said again, more importantly, the risks of what this product is all about. So we've got lots of forms of education. I think most of you are familiar with the OIC, so I would urge you, everything is funded by the industry. What it takes is our time. So have at it, all kinds of stuff online, as I think you know. These are the 5 parent exchanges, total of 15 exchanges overall. And I think one of the things that really sets the listed options markets apart is the clearing corporation. We've got the exchanges, but then you've got the OCC, which is the Options Clearing Corporation. And what the clearing corporation does is match each buy and sell ticket that takes place on the various exchanges. And that takes away counterparty risk. So whether you realize it or not, you've got this big entity called the OCC behind the scenes, matching every trade that takes place. Speaking of trades, we had this slide, in the first presentation as well. I could talk about this slide for 2 days. It's one of my very favorites. Dan pointed out, we started in '73. This is an industry that just started from nothing. As Dan said, we didn't have puts for the first 4 years. The SEC didn't approve puts in the industry till 1977. We started with 16 companies in April 1973 at the Chicago Board Options Exchange. We've got, I think it's close to 4,800 companies, indexes, and ETFs that have listed options now, close to 1 million strike prices. 1 million. All, moving at the speed of, well, we know how, as Dan pointed out, how quick you hit that button, things happen. So it's an incredible universe of technology that has grown dramatically, especially since the late 90s. A couple things happened in the late 90s. We got our first electronic exchange, which at the time was the ISE. Prior to that, and I had the good fortune to be on the floor for many of those preceding years. And you call your broker calls the guy on the floor or the girl on the floor, they run out to the crowd, there's a buy, there's a sell, they run back, get back on the phone, call the broker, and maybe 30 minutes later, if you're lucky, you had a report. Now, what's it take? You tell me. Seconds. And so the efficiency of the market increased dramatically in 99, 2000. Prior to 99, if you wanted to trade, let's say IBM, there were 5 exchanges, you could only trade IBM in Chicago, singularly listed. That changed in 99, 2000. So we had 5 marketplaces instead of 1. What do you think happened to bid-offer spreads? More competition, narrower spreads. So, we had electronic access, narrower markets, and we had advancement in technology. As Dan said today, so many of our partners, the exchanges, the broker-dealers, the tools they have online, along with us, of course, at optionseducation.org, the sophistication of the tools and the ability to access the markets, is why option volume has now expanded to the point where, this is an annualized chart. We've been doing over $4 billion for the last half dozen years or so. That breaks down to about 16, 17 million contracts a day. Any idea how many we're doing this year? And to me, the story, and I know I'm getting into the history a little bit, but the story of the options universe in the last half dozen years, think about all the complaints about no volatility in the marketplace. We'd maybe like to be able to complain about that, given the last month or two, with the extraordinary volatility in the marketplace. But for the last half dozen years, the market basically kind of went up without a lot of movement. But option volumes sustained. They didn't drop at all. A lot of people say, when you have volatility, that's when the option market comes alive. Well, the option market's been alive, despite that lower volatility. I think part of that is the 08-09 financial crisis. A lot of people got beat up and had no idea, maybe, how much risk they had in their portfolio. So they've come to events like this and educated themselves. They figured out a way to generate income, like Dan was talking about with the covered call. So volumes have sustained. This year we throw in some volatility. We've gone from about that average of 16.5 million contracts. We're doing just north of 20 million contracts a day. It's likely we're going to do 5 billion contracts for the first time in history. This past October, the busiest month in the history of the options business. This past October. So, it's a wonderful product. And the key, I think, is trying to decide how it works for you. Is it income generation? Is it protection? How do you want to use the product? And, getting back to the Iron Condor, we're going to talk about a way to kind of use a couple credit spreads to generate income. And we are, yes, question. What's that?
What are non-equities?
Okay, the question here, we've got some non-equity in gray. They are cash-settled index trades for the most part. Maybe a few foreign currency trades as well, but that's what that represents.
Can you repeat that again, please? They're called again?
Cash-settled index trades
Very well.
and some foreign currency trades as well.
Do they trade on a different?
They trade on the various exchanges. Yes. So, yes, another question.
In terms of this volume in October, how much was institutional as compared to retail?
Okay, so excellent question. In October and generally, I don't have a hardcore black and white number, and Dan, please, maybe you can add, but generally speaking, and the question is, how much volume of the 16 or 20 million contracts, and in this October period specifically, is retail versus institutional? Generally, about 1/3 retail, 2/3 institutional is, the ratio that I hear that tends to be fairly consistent. Dan, any different opinion?
Perfect.
Okay. But thank you. And one more. Yes?
Is there options on like commodities and metals?
The question is, are there options on commodities and metals? There are. I can't give you the exact symbol. I know you gave an ETF
On ETFs,
symbol.
sure.
Yeah. On ETFs primarily is where you would find the options on commodities and metals. And it just, as an aside, in the ETF space, I think we're in the neighborhood of ballpark 2,000 ETFs. Of that, I think about 600 have options listed on the ETFs. So, and one thing to always be aware of, we're doing a lot of volume. There might be close to 4,800 products. Some of them are extraordinarily liquid. And one good gauge of that, we've got weekly options of the universe of 4,800 underlyings. We've got weeklies on about 700 products. They tend to be the most liquid. Okay? Just be careful. Just because options are listed, you want to be cognizant of the amount of liquidity. You want to ideally be in situations where the bid-offer spreads are pretty competitive. So,
Is there options on forex contracts and commodities, future contracts?
well, the futures contracts are a different animal. The question was, are there forex options? And yes, there are on some of the exchanges. I apologize, I don't know the symbols off the top of my head.
For the euro, the symbol is XDE.
Okay, XDE for the euro.
And settled FX, trades and sells in US dollars.
So that's a little bit of the history. If you can't tell, I kind of like the history of the industry a little bit. I've been lucky enough to be part of it for quite a long time, and love talking about options. Getting back to the whole idea of income generation, risk management, we're going to talk about the iron condor, which brings the whole idea of spreads into play. And in our third presentation, we'll talk about collars. You can consider that a spread as well. But core concepts, iron condor is the name, but we're really talking about a bear call spread and a bull put spread. First of all, let me ask, how many of you here use spreads? Okay, maybe a third of you. Are you familiar with this idea of the bull call the bear call, vertical spreads? Are we familiar a little bit with the vertical spread? I'm seeing some heads nod. So let's get into a little bit of the idea of spread fundamentals first. So much in the option space is common sense. Common sense. And I think spread transactions are just an example of that. A spread. You buy one option, you sell another one. You're hedging the buy side with the sell side. You may not be hedging the entire portion of the long side contract, but the hedge oftentimes, or the spread, is a less risky transaction than just the naked buy or sell. A couple different types of spread types. I mentioned the whole idea of vertical spreads, up and down. Horizontal or time spreads. Talking about time. You're buying or selling time. In the option space, You've got the weekly contracts on about, that 650 different issues. Then you've got your regular options that go out about 18 months in time. And then beyond that, again, about 30% of the underlyings have leaps, longer dated options. And those options can go out almost 3 years. So when you talk about the horizontal trade or the time spread, the key there is it's the same strike price. Buying one period of time, selling another. Where the vertical, you're buying one strike, selling another strike. The diagonal, and I think this next slide can speak to that. You got a handful of strike prices from 80 to 100. You've got different time frames. If you look at that, the 85, 90 on the left-hand column in October, that'd be an example of a vertical spread going down to the 97 calls in the middle. That'd be a time spread, buying one, selling another. And then moving out to 2020, you can see that 85 strike is one to be long or short, and then you turn around and sell the 90 strike. That's clearly the diagonal. So these are different types of spread opportunities, different time frames, and different risks. Always thinking about the risks. Vertical spreads, as I've mentioned, you buy one option, you sell another. Same underlying, which might seem obvious, but we are talking about the same underlying. Same expiration dates for sure, but different strike prices. So here's an example just like we had in a couple slides back. The NOV calls, you got the 85 and 90s. So you could either buy the 85, sell the 90. You could sell the 85, buy the 90. In the Jan example, you've got a difference, and a key difference. Rather than a $5 increment, you've got a $10 increment in strike differential. Okay, but the idea with verticals, same expiration. Okay, just different strikes. That's the key. This example happens to be if you're buying the 85, selling the 90, buying the 80, selling the 90, that would be the bull call spread. The long call would be the lower, more expensive strike. Okay? Those two last bullets, when I talk about core concepts, that's what it's all about when we talk about vertical spreads. Maximum value, maximum risk. Okay? And I think Dan, would probably agree with me. I was lucky enough to spend a lot of years on the trading floor. And my mindset was not about, wow, dynamite. How much can I make? Always, and I think the reason I lasted more than 20 years was, first things first, is that four-letter word, risk. How much can I lose? All right, so I would urge you, we all want to make money for sure, but know the risk in trying to make that return. All right, so back to those last two bullets. Maximum value of a vertical spread. Any vertical spread, the maximum value is the difference between the strikes. So the one on the left-hand side obviously can be worth $5. The one on the right can be worth 10. No more, no less. Okay? And the maximum risk is going to be the debit you pay for that spread. Same with long call, long put. Most you can lose is what you pay for that option. With this spread, the most you can lose is the debit you pay. And we'll go through a couple examples. And, like Dan's presentation in round one, we had slides with all kinds of numbers. From my perspective, we want to keep it as simple as possible. So it's going to be that debit or credit that we create that spread for. That one number is what we want to keep track of and keep, a lot of those individual numbers out of the picture. But again, vertical spreads, maximum value, difference between the strikes. Could be dollar-wide strikes, $2.50, $5, 10, the expensive stocks, heck, it could be $50. But when you do that spread, as opposed to just buying or selling a put or a call, you've defined your risk. And there may be a lot of risk, but at least it's not unlimited risk. And that's why, frankly, we wanted to talk about the iron condor today. You know, it talks about these two key spreads, which are very straightforward. You put them together and boom, you've got an iron condor. Which, you know, again, talking about spreads, vertical spreads particularly, when we talk spreads, we're talking debit spreads, we're talking credit spreads. The debit spread, you're paying for it. You know, one option's costing more than the one you're taking money in for, the short option. On the credit side, it's just the opposite. And in our example with, you know, the iron condor, you'll see it is a couple different credit spreads that we bring together. So, again, defined risk is what almost all spreads bring to the table. Doesn't mean it's just a little bit of risk, but it's not, you know, one of these things that can just destroy your portfolio. So with that background, how about if we start with the call credit spread? Call credit spread. So I'll go through the slides, but think about that just conceptually first. We're obviously talking calls, and it's going to be a credit spread. So we're going to buy one, sell another. But if it's a credit, we're selling the more expensive option. Agreed?
Yes.
Bingo.
God bless you.
So we're selling a more expensive option, buying a less expensive option on the call side. So it's a credit spread. And that's, you know, why I'm a big believer. You know, so many of the concepts with options are very straightforward. Frankly, Dan, I think 8, 10, 12 key concepts. Dan talked about in the money, at the money, and out of the money earlier. There are 3. Things like this. If you understand this stuff, chances are you're going to be well informed, or at least informed enough to get into the option space if you think they work for you. So here we go. Let's why I call credit spread. Dan talked about also your forecast of things. Investor motivation. Well, in this example, and in all of our investments and option positions, obviously the motivation is to make cash. That goes without saying. But here, you know, we've got a stock, and as Dan also said, XYZ, our all-time favorite stock here at OIC. XYZ. How many of you own XYZ? How many of you are short XYZ? But we're big on XYZ. Stock's trading 88.50. And then, you know, next step, outlook. We're thinking maybe lowered unchanged in a really short time frame. We're talking a month. So that's honestly, I mean, that's a tight time frame. But that's where we are. Okay, we're just trying to hammer home some concepts. So we really don't expect the stock that's 88.50 to be north of 90, you know, over the next 28 days or so. A couple different choices. We could sell 100 shares of XYZ short. Now, I think most of us, trading stock on the short side is really for option pros the vast majority of the time. I mean, selling stock short may be part of your approach to investing, but I think that is a very minute part of a group like us. But that's a choice. You could sell 100 shares short. You could sell a call. Stock's 88.50. Heck, I don't think it's going up. I'm just going to sell some calls. Why not do that? Or maybe you want to do that. Who wants to just sell calls? Nobody raised their hand for you online. So I'm guessing maybe it has something to do with risk. What do you think? Okay. Yeah. Risk. Getting back to that 4-letter word. But we want to take in some income. We could sell some calls. And then our third choice in our example is sell a call spread. And That very last bullet down there at the bottom is an important point. Make sure you have broker approval, for sure. Okay? There are different levels. Different brokers have different rules. Just be sure you have broker approval. And whether you're using them or not, the spreads, it's a darn good idea to have these various approvals in place in advance. Because sometimes, all of a sudden you want to do it. Maybe time is of the essence. Couldn't happen fast enough. So that's just kind of due diligence about your account. Again, common sense. So here we are. Stock's 88.50, 28 days to expiration. 88.50. Think in terms of real. Okay, boom. There's so many numbers. That's why, to me, it's about, the concept of things. We know the stock's 88.50. We're talking about the 90 and 95 strikes. Okay? 2 strikes. Are those strikes in, at, or out of the money? Come on. I hear out of the money. Do we agree? Are they both out of the money? They are both out of the money, for sure. The 90's $1.50 out of the money, right? Stock's 88.50. That strike price is $1.50 higher than the stock price. So it's $1.50 out of the money. The 95s are $6.50 out of the money. They're both out of the money. We clear with that? Okay. Again, the forecast, we don't think the stock in 28 days is going to be north of 90. We think it's going to be, south of 90. All right? Individual numbers. Of course, the 90 call is going to be worth more than the 95. We agree with that, right? Because that 90 call represents the right to buy or sell stock at 90. The 95 represents the right to buy stock at 95. So, of course, that 90 strike is more valuable. Your numbers are 3.5 and $1.80. But again, all I really care about, what am I taking in? I'm taking in $170 per spread. Because we've sold the more expensive option. And it's a bare call spread. We've sold that more valuable 90 strike, and to protect ourselves, we're buying the 95 strike. We could have bought the 100 strike also. We could have bought the 110 strike. Okay, that would expand our risk big time. Let's say we bought the 100 strike instead of the 95 strike. Well, actually, I'll come back to that, one thing at a time. Maximum gain by selling the 90-95 call spread. I'll go back to this slide. What did we sell the spread for? $170, right? It's just like selling any option. Call, put, individual, or spread. The most you can make is the credit you take in. So our gain's 100. Our maximum gain is that 170. Maximum risk, 330. Does that make sense? Okay, I have a no over here. I appreciate your honesty. Let's go through it. 90-95. Difference between the strikes is $5. We agree. We take in $1.70. So what? If you take the difference between the strikes, $5, minus the 170, leaves 330. So that $330 is the risk if we're wrong and the stock goes to 95. If it goes to the beauty of the spread, if the stock went to 195. Let's say somebody decided, there was a big, a big takeover. Let's just leave it at a big takeover, and somebody decided to pay $195 for this company that's trading for $88.50. The beauty of owning, the reason we do that spread is so we know we can only lose the difference between the strikes minus the credit we take in this example, $330, $330. Make sense? Okay, good. Now, taking it a step further, if we didn't buy the 95 and bought the 100 call, how much money could we make? Assuming we did the spread for $1.70. How much could we make? $1.70, right? That's not changing. But by expanding the strike $5 higher, we've expanded our risk. So instead of potentially losing $3.30, we might lose $8.30. Now, then you have to ask yourself, okay, do I really want to, put on a position where I can make a maximum of $1.70 but potentially lose $8.30? That's honestly where the fun comes in. How strong is your opinion that the stock's not going up? That's part of it as well. The important thing is that you've sold one call and bought another to limit your risk. Okay? It's really important. I have one question over here. Yes?
But it's still, even if it's a limited risk, it still doesn't make sense to me to take 1 unit of profit and have 2 units of risk in the same trade.
Okay, and it's an excellent point. The question is, it doesn't make sense to this lady to only be willing to make 170 and potentially lose 330. So that risk-reward ratio, she says, I'm out. Makes perfect sense to me.
The question is, can you have X times the risk with that strategy?
So the question is, can you balance that risk-reward? Where instead of $1.70, $3.30, maybe it's $2.50, $2.50. 50-50. Yes, you can. It would be a different strike selection. It all is about, picking the strikes. And as Dan pointed out, in the covered call presentation, the tools that our partners at the brokerage houses have are phenomenal. They can help you, define things like this. But there you go, a perfect example. Taking 170 to make 330, I have no interest. Well, I might, but this lady doesn't. And honestly, that's what makes a market. The gentleman earlier talked about theoretical value. Theoretical values, it wasn't theoretical value, it was fair value. Fair value and theoretical value are a couple, in my mind, completely different things. Theoretical value is the value of an option based on the inputs. Fair value may be what you think is fair value, but the marketplace may have it priced completely different. So to me, it's the great part of of finance, but the options business specifically, there's so many drivers. In options, most of you are in the option space. You see these option premiums expand and contract. It's part of the fun. Trying to figure out, how do I make money, number one? But from my perspective, and I think all of yours, I think the goal is, and maybe why you're here, how do I make the most amount of money with the least amount of risk? And I'll go back to my trading days on the floor. Without question, I always felt best when I was wrong and didn't lose a lot of money, without question. That means I was making good decisions. I think that's why we're here. Why we don't want to just sell calls, chances are, because of the risk. Let's talk about a bear call spread. So, another question.
Wouldn't it make sense to compare the risk to reward from doing that spread to selling the naked call on a less level? You sell 5 naked calls, and that's the period.
Well, and the question is, wouldn't it make sense to compare selling the call spread to selling naked calls? It might, but I think the point here is, and we're going to speak a little bit about the whole, and we already have, selling calls, selling puts, lots of risk. So we're trying to, offer ways that investors can maybe take some credit out of the market with far less risk. And I get a lot of questions as we present, oftentimes, and it's frustrating to me, but oftentimes the answer I have to offer is, it depends. because so often investors are looking for a black and white answer, and I cannot answer so many questions because I don't know your risk tolerance. Again, Dan talked about that so many times. You got to know yourself as an investor. You got to start there. Know your risk tolerance. If you want to use options, stocks can do three things: up, down, and sideways. Have two good bullish strategies. Have two good bearish strategies. Have two good neutral strategies. And get good at them. But, oftentimes it's just not possible for us to give black and white answers to things that you're after if it's kind of an opinion question. That's why staying inside of these spreads we think is a good idea, where we define both the benefit and the risk. So we've talked about this a little bit, the call credit spread, selling the 90 call, buying the 95.
What happens if the stock, let's say, goes to 93?
Okay.
So if you sold the 90, right? So you have to either cover it.
Give me if you wouldn't mind. And the question is, we're short this 90-95 call spread. What happens if the stock goes to 93? I will be there in about 2 minutes. Okay? I'll just stay on track just a touch, but it's a great question. In terms of, we know what we've done. We've sold the 90-95 call spread. The stock's 88.50. What if the stock is below 90 at expiration? We talked 28 days. Our forecast was the stock to hang out around 88.50, but certainly be south of 90. What happens at expiration? What happens to our options if the stock's below 90?
They both expire worthless.
I hear they both expire worthless. What do you think about that?
Correct.
Agreed. Excellent. Let's go through it. Let's say the stock is out at 89.90. 89.90.
Well, what you probably want to do is buy.
We're short the 90 call. We're long the 95 call. The 90 call represents the right to buy stock at 90. Well, there's no way if the stock's below 90, the people who are long that option are going to exercise. It'd be cheaper to go, buy the stock. So those calls at expiration, the 90 call, are out of the money. So if the 90s are out of the money, clearly the 95s are out of the money. So exactly right. That spread, both options expire worthless. The spread goes out at 0, and we've collected our $170. So that's one. Number two, how about if the stock is above 95? Above 95. Talk to me. What do you think? What happens does the 90 call have value?
Yes.
It does. How about the 95 call with the stock above 95? The 95 call have value.
Yes.
Let's say the stock's 96 as an example. Okay? What's the value of the 90 call?
6.
I hear 6. Do we like 6? I like 6. Okay? That 90 call, the right to buy stock at 90 with the stock at 96 at expiration, definitely worth $6. Okay? The 95 call with the stock at 96 is worth how much? $1. Exactly. Now the key to the spread, and again, defining risk. So what was our forecast? 90 or lower, right? Were we dead wrong? We were dead wrong. Stock went north, almost 10%. All right? What happened? Go back to our maximum gain, maximum loss. How much do we lose? That difference between the strikes, okay? We took in 170, maximum distance between the strikes is 5. We lost $330, okay? Are we clear on that? But that is the beauty of having a spread on. And then in between, right here, sir, if the stock at expiration is between 90 and 95. And this gentleman was asking about $93. Does the 95 call have any value at expiration with the stock at 93? No. It's out of the money by $2, right? If it's out of the money at expiration, it has no value. The 90 call has how much value? $3. Okay, so at $93, at 93, the 90 call has $3 of value. The 95 has no value. What's the value of the spread? What's the value of the spread with the stock at 93 at expiration? $3. It's just the value of that one call.
Excuse me, if you
So
sold the 90 and it goes to 93, it will be put to you, right?
yes.
So you have
So,
to buy it back.
we're talking about value, and then, like many positions, there is management in that position responsible. So, at expiration, that 90 call gets assigned to you. It gets assigned. So, your choice is to either buy back the spread, just buy back the 90 call, or what's your position Monday morning going to be? You're going to be short 100 shares of stock. Okay? So you're exactly right. Your question is, if it's in between, don't you have to manage the position? You do. You need to either buy back the call or you will be short stock on Monday morning. Okay?
So instead of losing,
This, just a minute. Yes, sir.
so this seems like a good way to kind of limit your risk and limit your profit if you have a kind of direction on the underlying. So why can't you do the same thing by just having a stop loss and a profit take and just buy the negative position?
Just with the underlying.
No, buy a call, right? So, you know,
Okay.
full spread, like you buy a call, have a profit and a stop.
So the question is, what about, forget the spread, just sell a call, but have a stop limit order, with that call. Have a stop limit. So let's say you sell it at 3 and you want to be out at 4, you could potentially do that, but what if there's a corporate action that comes out of the blue and it happens overnight while the market's closed, and that stock that maybe was trading at 88.50 is now trading at, say, 110. It's a low probability that that could happen, but you do have that exposure in the market from a risk perspective. So that's the key difference. Okay? Something may happen while the markets are closed and you don't get stopped out. Okay? So.
Could you repeat why you said on Monday morning you'd be short the stuff? If it was assigned to you, you wouldn't be short.
So I will one more time, and then I'm going to have to move to the other side, because the Condor has two sides to a spread. All right? If the stock went out at $93 and we had the 90-95 bear call spread on, we'd be, if we don't buy back that call, if we don't buy back,
Assigned to you.
yes,
Why would you say you'd be short?
it's that you sold it. You sold the call. So the terminology is, if you sell the call and you get assigned, you're then short stock. So you're exactly right. You do have to buy back the call to avoid that exposure. Let me come back to you if you don't.
Instead of losing 330, you only lose 130.
Instead of losing,
$330.
yes,
Lose
okay,
only 100.
thank you. And so if the stock at expiration is $93, we sold the spread for $170, the spread's worth $3, we'd have lost $130 at 93. We need to close that 90 call back, or then we have the exposure of the short stock on Monday. We good with that? Yes, one in the corner.
Sorry, just one question. Supposing the stock was at $89.95.
Okay, so the question is, what if the stock's at $89.95? And
Does the person that paid the premium have the right to execute?
what was that?
Does the person that paid the premium have the right to execute?
The
premium I paid.
I'm with you. Any long option owner can exercise at any time. Okay? The way it works from the clearinghouse and brokerage perspective, and let's say that we got the 90 strike, and you've got the 90 call at $90.01, it's an automatic exercise. Automatic. At 89.99, it's a penny out of the money. You've got an option that's out of the money, and therefore it does not get assigned. So a long option holder can exercise at any time up to expiration, but in terms of automatic exercise and assignment, it's a penny in the money either way that determines whether something gets assigned.
When you do these spreads, do you take the dividend, the ex-dividend into consideration? So someone wouldn't assign you for the dividend because you want to price it out?
Yeah, and with the dividend perspective, let me, if you don't mind, get to the other half, because we've only got about 10 minutes to get through this Condor. You did a much better job getting all the way through than I am.
It's a great crowd. I mean, questions. This is what the purpose is, education. They get answers to questions.
Exactly, and really, thank you. Let me just to wrap up the whole other side of the Condor. The put, so we had the bear call spread, and on the flip side, we've got a put credit spread. Why the put credit spread? Well, again, we're trying to take some money out of the market. Investor outlook, XYZ should be higher or unchanged in the next 28 days, but not expected to move below 85. So we're flipping our thinking here, 100%. Flipping our thinking. It's the put side as opposed to the call side. Same stock, 88.50. 3 different choices. We could buy 100 shares. A lot of risk, a lot of margin. We could sell a naked put, just like we could sell a call. Not unlimited risk, but very significant risk for sure. Another way to get bullish could be to sell the put credit spread. Let's go through that example. Same stock, 88.50, same amount of time, 28 days to expiration. We've got the 85 strike and the 80 strike. Okay? So we're below the stock, but we're talking puts. Are these puts in or out of the money? I hear out. Out of the money. Let's go back to what a put represents. The 85 put, to buy the 85 put, represents the right to sell the stock at 85. With the stock at 88.50, it's $3.50 below the price of the stock, so it's $3.50 out of the money. So the 80 put is even further below. So notice, very similar to the call bear spread. $5 difference between the strikes. We got 205, we got 70. We're taking in $135 for this spread. The bull put spread. Same math applies. $5 between the strikes. The maximum gain is $135. So therefore, the maximum risk is going to be the difference between 5 minus the 135, 365. Lady over here certainly would have no interest whatsoever in doing that spread. None at all. It's even a worse ratio. But the opinion here is 85 or higher over the next 28 days.
So all of this will be based upon your own research in the underlying stock.
The comment is, and it's spot on, your strike price selection is then based on your homework, your forecast. And that's very often the case. There are investors, who believe in, the letter writers and different idea generators. Certainly the brokerage firms, support opinions of various stocks. So there are any number of resources. But to me, and Dan talked about it earlier, he likes technical analysis. I do as well. Where you have maybe a recipe for a handful of different option strategies. Maybe you have a handful of different techniques to formulate your bullish, bearish, and neutral opinions. So let's go through this put credit spread. Again, we're selling the more expensive put, buying the less expensive put, but we're buying that put, so we're covered. Stock above 85, think about, what are those options? Again, we've sold the 85 put, bought the 80 put, with the stock at expiration above 85. Is there any value to that spread? Very good. No value at all. So we've taken in the $135. How about below 80? Below 80, worst case scenario. We're going to be out the 365 because the 85 put is going to be worth at least $5, and that 80 put is going to be worth something. So that's the worst case scenario. But in that example, bottom line is we were wrong. So we deserve to lose money. The important thing is that our risk was defined. And then between 80 and 85, just like the call spread, between 90 and 95, at expiration, there's maintenance. That 85 put has value. The 80 put has no value. So if we're short an 80 put, or excuse me, an 85 put at expiration, what kind of position do we have at expiration if we don't close that spread? If we are assigned the 85 put, what's our position? We are long stock. Exactly. So if you don't want to be long stock, you've got to cover that position. All right? So we've got the bear call spread. We've got the put bull spread. Both credit spreads. What do? You bring them together and you've got the iron condor. And again, different choices with far different risk. You're selling out of the money call, selling out of the money put. That's a strangle. You could sell that. You could sell a call and a put, same strike, which would be a straddle. But again, back to risk. They're unlimited risk strategies. Unlimited risk. Sell that call spread, sell that put spread, 2 credits, the 170, the 135, with limited risk. Now we're talking, maybe a risk-reward strategy that works for this lady over here. We're talking about $3.05 credit with how much risk? $195. The difference between the strikes. We can't, have exposure on both the call and the put spread. The stock's only going to expire in one place. So does that? I think you're smiling over there.
But I'm still. It's not a matter of my view.
Yes.
But when you trade stocks, they tell you don't do anything without having at least 2 times or 3 times your risk. So I'm surprised. Is it the price you pay to have a defined outcome that you're going to have almost as much risk as gain?
That is the beauty in picking strike prices, and I think putting these 2 strategies together, you can obviously improve your risk-reward ratio very significantly. So here's the outline, and as you advance, in your, without getting too technical, but as you advance in your options knowledge, hopefully, your head starts to think in terms of charts like this. And I don't mean to scare you, but, it's the definition of risk-reward, and you can see that those important 2 numbers with the red lines, downside risk, your break even is 81.95. So it's that short 85 strike minus the 305 takes you to 81.05 being your downside. And then you potentially can lose that last 195 below that 81.95 strike. And then to the upside, you take that short 90 strike and add the 305, which is why we get 93.05. And again, out to 95, you can lose up to that 195. I think actually we may have a couple questions from online. We've got wonderful colleagues here supporting us. Alex Osenga. Lindsay Burke, Ed Modla is behind the scenes. You know, we've got a lot of people work for us behind the scenes. He's answering a lot of online questions. And okay, beautiful. So thanks for the questions from online. What about just doing one side of the spread is the first question. So there you go. We talked about the call bear spread. We talked about the put bull spread. What about just doing one side? Well, that gets back to almost, it depends how you feel about the underlying, how much risk you want, but certainly that is an option. So thank you for that. Next question. Any preference to the distance between strike prices? A great question. We talked to that a little bit. The distance between strikes. In our example, you know, we've got $5 strike increments. You get to those more expensive stocks, $5 is meaningless. But even, you know, maybe you, and we went through the one example where we're short the 90 call, and maybe, you know, instead of the 95s, we did the 100s or the 105s or 110s. It gets back to your risk. You may feel really strongly that XYZ at 88.50 isn't going up, but you don't want unlimited risk. So in answer to any preference for the distance between the strikes, I get back to, you know, it really depends on the amount of risk you want to take on. So thank you to the online folks for those questions. Let's see, just to kind of wrap this up, it's the idea of bringing two spreads together. And in our example, it's the call spread, the put spread. We got the iron condor. You know, give it some consideration. I think that commissions, when you're talking about multi-leg strategies, are always a factor. So you want to keep that idea in mind. And you know, I hope the whole idea does make sense. Dan, anything you want to offer?
Perfect.
Okay. Another question? Yeah, one more question, and then I have one other comment. Yes?
So just to concern, to do this, put this on, it's 4 bid asks you have to deal with, 4 commissions, and that's before you adjust and possibly close out at least one of the sides at some point. That's a lot of stuff in between you're giving up on commissions.
There can be, and again, different brokerage firms have different agreements as to, you know, whether a spread is 1 fee, 2 fees. So that's where, you know, knowing the nitty-gritty about how your brokers charge is very important. The last thing I'll add, and then we will be back at 11:30 for the collar strategy. Anybody online or here, we're very interested. We just launched a new website, so we're very interested in your feedback. If you're interested in offering that feedback, you can speak to Alex or Lindsay here in between the break or afterwards. And then to you folks online, I would urge you to reach out to our buddies at Investor Services at options@theocc.com. And and actually online, we can, if you're online now, I think you can go into the chat box, right, Alex? You go into the chat box. Please let us know you're interested in offering your opinions. We'd greatly appreciate it, and we'll be in touch with you. So with that, I think, you know, we've turned into, we're out of time. We've got a 15-minute break, and we'll be back at 11:30. So thank you.